Lose $500,000 in 6 months just selling pig leg rice? What can Singaporean investors like you and me really learn from this local hawker chain's sharp fall? Welcome back to the Investing Iguana. I'm Iggy, your trusty guide to turning complex finance into bite-sized, actionable lessons any Singaporean can use. Today, we're diving into the real financial story behind Shiny Pigleg Rice's rapid rise, fast stumble, and the $500,000 loss that every investor needs to understand. Adapted from my latest deep dive Substack article, we'll unpack the business, show why profits matter more than sales, and reveal the investor red flags hiding in plain sight. All charts, tables, and frameworks will be clearly explained. I'm Iggy, a Singapore-based investor who's made, lost, and learned in the SGX trenches. I break down markets, stocks, CPF and SRS strategies, and F&B case studies like this one, always with a Singapore twist. Stick with me as I break this story into 5 pivotal chapters: the Hawker paradox, when growth hurts; the Shinian dream and crash, unstructured expansion and investor risks; what caused the $500K loss; and the investor playbook, lessons and next steps. Let's get right in. Let's start with the big question. Why do we Singaporean investors love a high-growth story so much, especially when it's something close to the heart, like a hawker chain going island-wide? But what if that rocket ship suddenly nosedives? Shinian's collapse isn't just another F&B sob story. It's a finance masterclass in disguise. Today, you'll see it's about way more than pork leg rice. We'll be talking rigorous math, real Singapore business conditions, and the powerful difference between growing fast and growing well. What's the lesson here? Sometimes the chase for rapid expansion sets up a company for pain instead of profit. Are you looking at sales numbers, or are you checking if each new branch or business actually makes money? Shiny Pigleg Rice didn't start as an empire. It began as Linji in 2019. A single outlet, just like the one near your HDB. But in just 2 years, it exploded to more than 30 stores. That's faster than most bubble tea chains. Singapore's media was buzzing. Everyone thought, wow, this one confirmed make it big. But by late 2024, the music stopped. Most outlets shut down. It wasn't COVID. It was classic business problems. Growing too fast without structure, losing sight of quality, and running out of cash. The founder came clean online, using a slick video to admit unstructured growth and promising to rebuild. And that's how a hawker success story turned into a finance warning sign for all of us. Have you ever seen a favorite shop or chain disappear just as quickly as it arrived? What signals did you miss? Let's break down the causes. What exactly is unstructured growth? Here's what happened with Nian and what every investor, F&B, or tech should spot. Too many outlets, too fast. Can you guarantee the same taste and service at every store? Shinian couldn't. Brand trust faded. Customers noticed portions and flavors weren't consistent. Repeat business vanished. Messy operations. There was no rock-solid system. Different processes. Unpredictable stock. Waste grew. Costs spiked. Management overstretched. Imagine running 30 stores with one tiny team. Things slipped through the cracks, from cash handling to quality checks. Money drain. All those new stores needed cash, fast. But if each one couldn't turn a profit quickly, it just burned money. That's capital misallocation in action. Let's look at key F&B business models to see the choices. Organic growth. One store at a time, slow but stable. Keeps quality high, brand strong. Rapid corporate expansion. Shinian's choice. Go big, open fast. You control everything, but risk high costs and stretched resources. Franchising, outsourced growth. Others pay to run your brand. Good for expanding without so much capital, but risky if franchisees cut corners. Strategic partnerships. Team up with others, share the risk and reward, often slower but more sustainable. Which approach fits your risk profile? As an investor, always ask, is this business growing with good systems or just rushing to open more doors for the sake of numbers? Here's the financial breakdown. Shinian lost $500,000 in just 6 months. A shocking but not uncommon outcome in F&B. Here are the culprits. Thin margins, big costs. Labor is expensive in Singapore. Everyone feels it. Hawkers, food courts, even big chains. Food costs, COGS, are rising fast thanks to global inflation and supply chain issues. A typical SG Hawker stall spends 30-40% of sales on food, 25-35% on labor, 10 to 20% on rent and utilities. Admin eats up a bit more. That leaves just 5-10% or less as actual profit. A single mistake can wipe that out. Failed pricing and value. They raised prices from $4.90 to $6.90 for a bigger meal. Customers pushed back, saying it wasn't filling or worth it. In Singapore, value means not just taste, but satisfaction. The portion, price, and experience all matter. If a business can't raise prices without losing customers, profits are fragile. This kind of price sensitivity is a key Singapore trait. Ignore it, and sales will drop. Operational weakness. When things got big, nothing was standardized. Recipes, supply logistics, training, all were different across stores. That led to waste, inconsistent quality, and high staff turnover. More time and money got eaten up by recruiting and fixing errors. Inflation squeeze. Food inflation in Singapore has outpaced overall inflation for a few years. Ingredients cost more than ever, squeezing those razor-thin margins. If a business can't pass costs on, it bleeds money. So investors always check, are margins stable? Can costs be managed, or is every dollar they make already spoken for? To fix the business, Nian needs to slow down and rebuild the basics. Here's Iggy's investor turnaround checklist summarized. Make every store profitable, slash waste and costs. Double down on best sellers, ditch the rest. Use standard processes for everything. Fix the value proposition. If you must charge higher prices, give something extra, bigger portions, better quality. Be upfront about price changes. Customers respect honesty and transparency. Expand cautiously, no rushing. Test each new location before opening it. Consider more franchising if the model is test-proven. Use digital tools to automate and engage, like loyalty apps or online ordering. Strengthen the team. Hire experienced operations and finance experts. Don't expect the founder to handle everything. Real growth needs real leadership. Ask yourself, as an investor, is this business built on systems and a team, or just the founder's passion? And is every ringgit put to productive use? All right, what can Singaporean investors actually do with all this? Growth must equal profits. Don't be blinded by sales or expansion headlines. Dig into financials, profit margins, cash flow, and how much debt is required. Know the market. Singapore customers are choosy. They want value and reliable quality, not just a good story. If a company can't win loyalty here, be extra cautious. Look for strong management and boards. Transparent, skilled leaders and advisory boards reduce risk. Check company announcements. Look for turnover. Dig for experience. Always diversify. Don't put all your CPF or SRS into F&B, property, or any single sector. Spread it out, because one downturn shouldn't hurt your whole financial future. Key metrics to track: gross profit and operating margins. Are core businesses making real money? Average revenue per outlet. Is each branch strong or dragging the group down? Labor cost as a percentage of revenue. Is staffing getting more efficient or out of control? Inventory turnover. Fast is good, slow means spoilage or poor sales. Cash conversion. The quicker, the better for survival and reinvestment. Review these before you buy, not after the headlines hit. My own view, Nian's downfall is a classic case of too much too soon. In Singapore, growth for its own sake often starts strong but ends in pain. Investors who check the basics, true profitability per store, cost structure, leadership depth, and customer loyalty, can spot these risks before they burn a hole in your portfolio. Don't just chase expansion or hype. Every dollar invested should come with hard questions. Would you want your CPF or SRS money riding on this business? Can it survive a cost shock or slow sales? Does it have the right team, systems, and market fit? Your best defense is to spread your investment bets, check the real numbers, and focus on businesses that perform in good times and bad. And remember, turnarounds are possible if the fundamentals are fixed. So don't write off busted F&Bs, but demand a clear recovery plan that makes financial sense. Have you ever been tempted by a flash-in-the-pan growth story? What red flags will you look for next time? So what did we learn today? Fast growth is exciting, but only profits pay your bills. Know your market. Trust clear management. Make diversification your safety net. And always, always follow the numbers. Bring these lessons into your SGX journey, your CPF and SRS investing, or even your next hawker meal. Because every investment, big or small, starts with solid basics. If you found this helpful, hit like, share this with a Singaporean investor who needs to hear it, and subscribe for more easy-to-follow, Singapore-focused investing breakdowns. Want premium playbooks, charts, and deep dives? Join the Investing Iguana Premium Club today. Members get subscriber-only content, tools, and early access to all my most actionable analysis. Check out the next video on screen for more on how to spot quality companies and avoid the hype. Until next time, invest smart, eat well, and stay curious, Singapore.